Hello you instant curiosity followers. In our journey through the deep waters of economy and finance, today I will take you behind the scenes of the strategic moves of giant companies, that is, into the world of mergers and acquisitions, M&A. Maybe you've heard about one company acquiring another, or two giants joining forces. So why are these moves made? How do they affect the economy and our pockets? Mergers and acquisitions are not only the biggest deals in the business world, but also strategic decisions that deeply affect the dynamics of markets, competition, and even consumers' choices. Today, we will discuss this complex yet fascinating subject in full detail, discussing its causes, types, processes, and what it means for investors. If you are ready, let's unveil the mystery of these huge agreements that shape the invisible hand of the markets. What is M&A and why is it done? First, let's clarify what merger and acquisition means. A merger is the voluntary coming together of two companies, usually of similar size, to form a single new company. For example, Company A and Company B merge to form Company C. Acquisition is when a larger company takes control of a smaller company, usually by purchasing the majority of its shares. Here, while the acquiring company continues to exist, the acquired company usually becomes a part of it. Now let's get to the real question: why do companies enter into these large agreements, taking risks worth billions of dollars? There are many basic motivations. The first and perhaps the most important of these is to create synergy. Synergy means that two combined companies create more value than they would achieve alone. This may come in the form of cost savings, more efficient operations, or increased revenue. A second reason is to increase market share or enter new markets. It is quite common to become a market leader by purchasing a rival company or to step into that market by purchasing a company in a foreign country. The third is the desire to diversify the product range or gain access to new technologies, expertise, and capabilities. Especially in the technology world, it is common for large companies to acquire innovative startups and acquire them. Finally, financial motivations such as tax advantages or benefiting from economies of scale may also influence these decisions. Merger and acquisition types. Mergers and acquisitions can be divided into different types based on their strategies and objectives. Let's take a look at the most common ones. First, there are horizontal mergers and acquisitions. This is the merger of two companies operating in the same industry and offering similar products or services. For example, the merger of two automobile manufacturers. The main goal here is usually to increase market share, reduce competition, and create economies of scale. Secondly, we can talk about vertical mergers and acquisitions. In this case, a merger or acquisition occurs between a supplier and its customer. Let's say a coffee chain buys a farm that produces its own coffee beans. This is done in order to provide greater control over the supply chain, reduce costs, and increase efficiency. The third type is conglomerate mergers and acquisitions. These are mergers of companies operating in completely different sectors. For example, a technology company purchasing a food manufacturer. The aim here is generally to diversify risks, diversify revenue streams, and capture growth potential in different sectors. Finally, sometimes hostile takeovers can occur. This is when the target company's management gains control of the acquiring company by purchasing shares directly from the shareholders, even though the target company does not accept the offer. Such situations can often lead to large fluctuations in the market and create uncertainty about the future of the company. M and the process, step by step. Although the merger and acquisition process may seem like just a signature from the outside, it is actually a very complex, long and multi-stage journey. Each step of this process requires great care and strategic thinking. The first step is to identify potential targets and analyze strategic fit. The company researches what goals it wants to achieve and which companies might be suitable for these goals. Initial contacts are then made with the target company and, if interest is mutual, confidentiality agreements are signed. These agreements are to prevent sensitive information from leaking out. Perhaps one of the most critical stages of the process is the detailed review called due diligence or due diligence. The company considering purchasing carefully examines the financial statements, operational processes, legal obligations, customer portfolio, human resources, and potential risks of the target company. This ensures you fully understand what you are buying. Once due diligence is completed, the value of the target company is determined. This valuation process is done using a variety of financial models and methodologies and is often the ultimate negotiable. If the valuation is agreed, an offer is made and negotiations begin. At this stage, in addition to the price, all other details of the agreement, payment terms, integration plans, and management structure are discussed. Once agreement is reached, binding contracts are signed. But all is not lost. Large deals often need approval from regulatory authorities such as competition authorities. These institutions examine whether the merger will lead to monopolization in the market or distort competition. Once all approvals are received, the final phase, integration, begins. This is the merging of the cultures, operations, and systems of two different companies under one roof. The success of the integration often directly affects the long-term success of the merger and is often considered the most challenging phase. The importance of M&A for investors. So what do all these mergers and acquisitions mean for retail investors? These deals can lead to significant movements and opportunities in stock markets, but they also introduce certain risks. When a company announces that it will acquire another company, the target company's stock price usually tends to rise. Because the purchase offer is usually made at a premium above the market price. This may create arbitrage opportunities. That is, investors can hope to make a profit by buying shares of the target company after the announcement and selling them once the deal is completed. But this is not a simple equation. Factors such as the risk of deal cancellation, failure to obtain regulatory approvals, or taking longer than expected could put these potential gains at risk. Shares of the purchasing company may react differently depending on the financial structure and strategic logic of the agreement. If the market believes the acquisition will add value to the company in the long run, the stock may rise. However, if the purchase price is deemed too high or integration risks are large, the stock could remain under pressure. The important thing for investors here is to carefully examine the announced agreements. It is necessary to understand how the acquisition will be reflected in the company's balance sheet, how it will affect the debt ratio, and how it will change the future earnings potential. For long-term investors, looking at whether a company's M&A strategy is consistent and whether it has successfully exited previous mergers can provide important clues about its management quality. Every deal has its own dynamics, and past successes do not guarantee the future. Therefore, detailed analysis and informed decision-making are essential for investors in the face of M&A news. Closing. As you can see, mergers and acquisitions aren't just about big numbers and company names making headlines. They are the cornerstones of companies' growth strategies, competitive dynamics, and even the future of the global economy. While these complex processes can create extraordinary value when managed correctly, wrong steps can also lead to great disappointments. As St. Anlec Marac, we believe that understanding such in-depth issues in the markets is an important compass that will guide us in our investment decisions. I hope this section has cleared up many of your questions about why companies sign giant agreements and how these agreements affect the markets. Remember, financial literacy is the most valuable asset every investor should have. Don't forget to subscribe to our channel, like the video, and support us with your comments. We will be back with different economic topics in the coming episodes. I wish you healthy and conscious investments. Goodbye.